Now, I'm joined by John Jacquemin, who is founder and president of Mooring Financial Corporation. His Mooring Intrepid Opportunity Fund was founded in March 2007 to bet against, in his words, unsustainable levels of spending, debt, speculation and other factors. It returned 213% in the first 2 years. Mr. Jacquemin, very good day. Thanks for joining us today.
It's my pleasure to be here, Gordon.
We have, as I noted, within 8 months got to a point where banks are repaying their bailouts. What do you think about that?
Well, I think if I were a bank, I'd want to repay it as well, because you're already a regulated institution, and this would make you ultra-regulated. So whether or not you really needed the capital, you'd want to get rid of it as quickly as you could.
Does it make sense, though? I mean, you can understand it from the bank's point of view, but from an industry point of view, and particularly from an investor point of view, do you like to see this kind of thing happening, or are the banks digging a bigger hole for themselves down the road?
Some of them may be digging a bigger hole. You know, we're only looking here at the biggest banks, and some of the ones that we think are weakest, like Wells Fargo, for example, in terms of the toxicity, if you will, of their portfolios, are not being permitted to pay it back. I think they really need the capital. Others, I think, could be on the margin. It's really hard to tell. But I think that everybody assumes that they're going to be bailed out by earning their way out of the hole with a recovering economy.
And the earnings, and we're showing a graphic which comes from one of your latest reports, suggests that they're boosting earnings partly in two ways. Pumping earnings by ignoring the market value of toxic assets and taking no loss reserves on their toxic loan portfolios. They are allowed to do this because of changes to accounting rules. Does that concern you?
Yes, it does, as a matter of fact. I think that much of this is done for show and to inspire confidence. But it's done to hide the problems that are there that are not going to go away all by themselves with an accounting rule or by failing to reserve sufficient amounts for weak loans or loan losses in the future.
Okay, I'm going to just show a quick series of charts for the viewers here. First one showing how financial shares have surged over the last 3 months or so. As Michelle noted earlier on, the S&P 500 Financials Index has taken off. There goes that chart. Short funds, in the meantime, have plunged, as you might expect. That's the inverse of that. When we look at the market, now consumer credit plunged almost $16 billion in April. That was more than twice as much as forecast. On top of that, we've seen mortgage delinquencies continue rising up to the first quarter of 2009. On top of that, of course, you've got commercial real estate concerns. I mean, how weak are credit markets, the loan market, right now, would you say?
Well, I'm not surprised by the reduction of consumer credit, because that's really part of the scenario that we see going forward. We see the consumer continuing to increase savings from a zero level 5 months ago to last reported a 5.6% level. We see that continuing at this level or higher. And we see that as an indication that there are very weak parts of our economy that were built up to cater to unsustainable demand, unsustainable spending, with the consumer on a spending spree, increasing debt to record levels, 130% of disposable income, never been higher. And that has to stabilize. The consumer has taken a real beating in terms of net worth. When you look at the value of the primary asset, the home, when you look at the value of equities for those who have equity portfolios, it's been a real disaster. It's been a big hit. And so the consumer is doing what the consumer should be doing. Yes.
Okay, John, we're going to take a quick break. When we come back, we're going to talk about how to play this market in that case, which investments you're recommending, both in the finance sector, also in the commodities sector. That's here on the Bloomberg Edge after the break. Send us your emails, asiaedge@bloomberg.net, asiaedge@bloomberg.net. Welcome back. Well, I'm speaking to John Jacquemin, who's founder and president of Mooring Financial Corporation, which bet on the financial crisis back in March 2007. As I've noted, returned 213% in the first 2 years. That was up to the end of March. John, what you're recommending now, as we were pointing out in the first half, is you still see some weakness, particularly in commercial real estate and some of the loan portfolios at some of the banks. So, couple of trades here, one of which is short the regional banks. You're doing that via an ETF, KRE. You're shorting the actual ETF because that ETF tracks the KBW Regional Banks Index, yes?
That's correct. We also have some selected shorts on specific banks, but we're concentrating on the index.
Okay, and part of that is because of your concerns about commercial real estate. Now, Real Estate Econometrics says the default rate on commercial mortgages may rise to 4.1% in the fourth quarter. That would be the highest since the savings and loans crisis of 1992, and it says it will keep rising through 2010 as well. You also recommend shorting commercial real estate by shorting the Dow Jones Real Estate Index using the ETF IWR, shorting that ETF.
IYR, yes. Yes, indeed.
Well,
we think that there's going to be quite a lot of. We think there's going to be quite a lot of continued weakness in commercial real estate, and you know we have basically 4 factors that create a perfect storm for the drop in real estate values. And I'll try to go through them quickly, but we have lower net operating income due to lower rents and and higher vacancies. We have lower leverage, we have higher interest rates, and we have higher cap rate demands by investors. When you take all 4 of those factors together, it really wallops the value of commercial real estate. Now, on the regional bank side, there are many...
go ahead on the regional banks.
On the regional bank side, the regional banks have quite an exposure to commercial real estate. And they have not written down or adjusted the values or created reserves sufficient to reflect the drop in the commercial real estate values. So I think many of them are in danger of being insolvent if they really came forth and discounted the real estate the way it should be.
I'm interested that you're going for the regional banks rather than the financial sector as a whole, because of course you do have the high-profile double short ETF, SKF, which shorts the S&P 500 financials, and there are other short ETFs, which includes the big banks, Bank of America, Citigroup, etc. Why are you staying away from those, or do you like those but you have much smaller positions?
No, we have not shorted the money center banks. We think they have a lot of other revenue-generating means that the regional banks don't have. So we think the regional banks are more exposed to the commercial real estate sector than the large banks.
Okay, now that's the financial sector. Let me move on to another theme which you do like, where you're going long, and this is basically boils down to a single commodity, natural gas. Natural gas has lost 1/3 of its value this year, even as crude oil prices have surged, as we know. Before we look at the specific trades, what do you think is going on? Why has natural gas stayed so low?
Well, we have record inventories, number one, and number two, we have record new finds. We have the Haynesville area that has greatly increased the reserves in the U.S. Now, I think that's all good news, but initially the market, the spot prices are taking a beating. So we've really gotten out of whack here between the relationship between oil and gas prices. If you take a norm, a long-term norm, it's about 8.5 to 1. Now, if you take 8.5 times the current price of gas, you're at $30 a barrel, which is less than half of where oil is trading. So you've got a real dislocation here.
So you're betting on natural gas prices catching up and, of course, therefore, natural gas producers benefiting as well. So you're looking at a couple of ETFs, the United States Natural Gas Fund, which bets on the commodity futures, and the ISE Revere Natural Gas Index Fund, that's FCG. The first one is UNG, which bets on the producers, yes?
That's correct. One tracks the actual price of natural gas, and the other tracks an index of explorers and producers.
Are you also selecting... You're probably going to say it. You're also selecting some specific gas producers, yes?
Yes, we are.
When you go for stocks rather than sector ETFs, what do you look for in particular? Are you looking at growth? Are you looking at balance sheet strength? What?
It's a sector that's rather new to us. We have an analyst who is researching this sector and looking for some gems, if you will, that have a combination of sufficient cash flow to maintain their activities, which is one of the problems in the industry, as well as the reserves for future growth.
One strategy to play the differential between natural gas and oil would be to go long natural gas, but at the same time to short crude oil. You're not interested in doing that?
You know, we looked at that trade and it scared us because we've seen many funds, in fact, do spreads that appeared logical and ended up losing on both sides. So we prefer to just be on the gas side at this point in time.
Okay, fair enough. Let me summarise what your picks are today then. Short regional banks by shorting the ETF KRE, short commercial real estate by shorting the ETF IWR, but go long natural gas, that's buying the ETFs UNG, tracking commodity futures, and FCG, which tracks the producers. Just a very quick word on your other funds. You've got commercial loans, credit derivatives, you've also got property liens. Which of your funds is doing best at the moment?
Well, year to date, the Mooring Intrepid Opportunity Fund is doing the best, but that is the highest risk profile. That's the one that is up over 200% in 2 years. We're up about 15.6% in the first 4 months. Mooring Capital Fund, on the other hand, which has distressed debt as its primary investment, continues to rack up, I shouldn't say rack up, to have pretty reliable 12 to 13% annual gains. In fact, this is the 10-year anniversary of Mooring Capital Fund, and we have a compounded quarterly rate of return of 12.6%.
John, we're going to wrap it up right there. Thank you very much indeed for your time today. Superb stuff. John Jacquemin, founder and president of Mooring Financial Corporation.